Enjoy your meeting. Just a reminder, today's meeting is being recorded.
Hey everybody. Okay, we're working. Okay, this is Tech Talk Tuesday. I'm David Blake, and today we're going to go over a couple of the last few days again, see what's going on with the market. If this is your first time here, we usually take about 25 minutes to look over some of the charts, go over some of the industries and sectors, and see if we can make some sense of what's going on. Right now, today we're going to do something a little bit different, and I'll try to keep it in with our allotted time. But I wanted to take a quick look at some of the indices, and I also wanted to touch base on our CTI model that we have been bringing back in. We brought it in last fall, just to help us give a market posture, which has been bearish since I believe around Thanksgiving week. And we're going to start to expand that out over the next couple of weeks, so you can see how our CTI I think has come back into sync, which I think will be beneficial for all our subscribers and all. Okay, the first slide I want to show you. We've had a pretty rough start to the start of the new year. I think it's the worst start in history for the Dow Jones S&P 500. And the first slide that I want to present is from Pension Partners, and Michael Guy, an acquaintance of mine, put this together last week on Thursday. And what this shows is 34 different stock markets around the globe and how far they are off of their 52-week highs. It's also going to show you, if you look over here on the right-hand side, that probably out of the global markets right now, about 17 or about half of them are already in bear markets. That includes, as of last week, Germany, Sweden, Brazil, Taiwan, Singapore. And also, if you look over here in this part over here, we only have about 3 markets globally that are trading above their 200-day moving average. Okay, another thing it shows is that since last August, we've only had 5 markets around the globe able to make a new high. So not only is the U.S. market struggling in here, but this is something that's going on around the rest of the world. And you don't look for a single pocket of strength in these markets. The global markets will usually trend together, and this is telling you that our market is one of the stronger ones globally right now. But when you have this many markets that are down 20-25%, they usually are going to drag our market down with it. So this is something that I think you wanted to see. Down here, as of last Thursday at the close, I believe, the average market around the globe was down 17.8%, just shy of bear market territory. And I don't see this turning around anytime soon. So that shows you where we're coming from globally. And yes, the United States market is one of the best performers right now. But certainly, I believe we're going to have some more downside at this stage. Okay, if you've been attending these webinars, a lot of times I've been talking about that I thought the Dow Jones Transportation Index was one that kind of held the key as to whether or not we were going to slip, how far we were going to go. We tried to have a rally back here around December. We just couldn't even make it up to the 50-day moving average, and now we've backed off again. But you can see here, going back to about 2009, the long-term uptrend for the Dow Jones Transportation Index was broken last week. And now we've gotten to the point where we are trying to hold support at this 38.2% retracement from the 2009 lows. And one of the reasons we want to look at this Dow Jones Transportation Index is if you're a student of the market, you'll know that you'll be familiar with something called the Dow theory. And this was work that evolved from Charles Dow around 1900. And although it has several tenets is what makes up the Dow theory, but in a nutshell, it states that stocks will usually be in a major trend, either bullish or bearish. Price action determines the trend, and the Dow Jones and Dow Jones Transportation Index will usually confirm each other's trend. Okay, now some modern investors don't believe the transportation index is as relevant as it was 75 or 80 years ago, but it has worked in the past. And the idea is that as business begins making more products, the transports, which include the rail, the truck, ships, that type of thing, need to move the product. Thus, they support each other when the economy is growing, and they both suffer when the economy slows. Okay, now the other side of this right now says that we're more of a service-oriented society, which is probably true, and that the Dow theory may be outdated. But until I hear more people say it is, we're not going to argue about it today. But I think it's something that needs to be watched. So the Dow Jones Transportation Index, as of last Friday, was down about 24% from its high on over here at 1214, right up in this area. So the first thing I want to point out is that right now the transports are already in a bear market. Okay, so this long-term chart going back to 2009 is trading below the 200-week moving average, trading below the trend line, and we're struggling to hold this 38.2% retracement level, which is a sign of weakness. If we would break that 38.2% retracement level, let me go back again, that's going to open the door for possibly a move down here to just below 6,000. Not sure that would happen, but if the bear market would start to pick up and we go into a real bear market, that would be a downside target that you'd want to watch. So this level in here, right below, right around 6,850, 6,900, is kind of important to watch. Okay, now here's the 1-year chart of the transportation. Clearly in a downtrend. It's really rolled over again. Some people were hoping that the sell-off in oil might actually help some of these. I think it is probably helping the airlines, but not the shipping business because we're just not moving any commodities. You can see over here where the long-term MACD is bearish. Relative strength is right around 30. That's bearish, but we are oversold, which makes sense when you see a move like this. But again, transports may still lead, indicate whether we're going to how far we're going to go on this thing, on this pullback. Okay, now here's the Dow Jones Transportation Index. As you can see over here, going back to 2009, we bounced off of this trend line 1, 2, 3, 4, broke through it over there. We rallied back after we bounced off the 200-week moving average, bounced back above the trend line, and rolled over again. So we've broken that. A sell-off down here below 16,000, which represents the 200-week moving average, is also going to be very negative and probably open the door down to a pullback down here of around roughly 14.5. That would be the 38.2% Fibonacci retracement level from that move off of the 2009 low. We're not in a bear market yet, but we're starting to approach that level, and I would say at this point the 16,000 is probably going to get broken because that'll take us back for a retest of the August lows. Okay, here's the 1 year of the industrial, and off of this break from August to November highs, we've already broken the 50% in the 61.8% retracement level here. The last 2 days we've had a short spike that didn't even make it to the end of the day, and we've turned negative. We were up 192 points this morning. We were just in the red a couple of minutes ago once oil turned over. So this is telling you you're probably going to get at least a test down here to around the 16,000 level where we did find support back in September before we started the big rally. A break below the 16,000 would be another signal that we could have certainly could intensify a little bit. Okay, now we're going to look at the S&P 500, and again, it's the same chart. We got the long-term trend line going up here. We're bouncing at 1, 2, 3, 4. Got a little bit ahead of ourselves, came down, tested it again twice over here in August and September, and we're in the process right now of breaking that longer-term uptrend again. If we're basically almost at the August-September lows on that, that's kind of setting us up for a pullback down here to the 200-week moving average, which would be right around 1,800. So we'll watch that carefully. Here's the 1-year chart. As you can see over here, where this 1880 represents a big support level, 1870 to 1880. So we want to make sure we hold on to that. We break that. It's a long ways down to 1,800, so that could intensify selling. MACD's bearish. RSI, 14-day RSI is also bearish, a little bit oversold, but that's the line in the sand for the S&P 500, this 1870, 1880 level, and I would keep that on your agenda there. Okay, next we're going to look at another market that is right at the bear level, bear market level. That's the Russell 2000. In a strong market, generally you'd like to see some of the small caps, especially domestic small caps, trying to lead the way. I think we're, as of Friday, I think we're at 19.3 off of the high, so we may have already entered a bear market with the Russell 2000. We're come back down here to the Fibonacci retracement level off this low down here, and you're looking at right around 990 to 1,000 on the Russell 2000. We closed, I think, 1043 or something yesterday. Let's see. Closed yesterday at 1041, so we've got a little ways to go on this thing, but the break of the 200-day moving average is also bearish. I think we're probably going to get a run down here into around the 1,000 area. We're already trading below the August-September lows, as you can see over here. We took it out. It cut right through it. It didn't even hesitate to try to hold support at that level. So that's always another sign that now you have two markets here in the States that are already in bear markets. So we need to watch that. Watch with the S&P 500 what it does here over the next week or so. And I think as early as this week we could test this August-September low on that. Okay, next thing, what we pull up a lot of times. Here's this is the NYSE advanced decline line, which a lot of technicians will interpret this as a leading indicator of market direction. And you can see we're back into another pattern of lower highs, lower lows. Yesterday we took out the low from mid-December, and also the NASDAQ advanced decline line, I think, put in a new 52-week low. Yeah, look at this over here. We tried to find support back here from the September low. December low came in here. We kind of held support on the advanced decline line, and now we've just rolled over on that again. A big part of this was where you had some breakdown in the FANG stocks, and you've had Facebook go from about 111, 112 down to about 95, and some of the other ones that are, Google and Alphabet also are pulling back. So we want to watch the advanced decline line. If this is a leading indicator, we want to start seeing something like this pattern where you're trying to make a bottom and you're seeing some more participation, but we don't have that quite yet. So look over here. Here's the NYSE new high, new lows. We're back up here making 600, 500, 600, 700 new lows every day versus 9 or 10 new highs. Not where you want to be. Again, one of the other things I watch for besides the advanced decline and new high, new lows is I track what percent of stocks are above the 50-day and 200-day. As of Friday, we had about last week we were at about 15% of the stocks that Market Edge follows above the 50-day moving average, and only 20.8% were trading above the 200-day moving average. That's very oversold readings. We did reach that level on the 50-day back in August, but it wasn't until early October that we got the 200-day back under around 20%. So that's a sign of weakness in there. And another thing that I watch, as of the close yesterday, only 10.1% of the stocks that we follow are trading above the 10-day moving average. That's something I like to track. When you get below 10% of stocks trading below the 10-day moving average, you can usually back the truck up a little bit because you're going to have have a bounce. This morning we had almost a 200-point bounce. It couldn't hold. That's another sign of weakness. Something else I follow is how many stocks are leading or holding this market up. As of this morning, only 4% of the stocks that we follow are within 2% of their 52-week high versus 43% are within 2% of a new low. Back in August and September, I think we got down to about 35% of the stocks were within 1% of 2% of a new low. So again, this is another indicator that says that we're oversold, that we could have a bounce, but I think if we do get a 3 or 4 or 5 day bounce because of crude oil picking up or something like that, I think it's an excuse to take some profits off the table. So basically, are we slipping into a bear market? The mountain of evidence seems to support that we're going to struggle in here to hold this lows from the August September thing. Now, one thing I was discussing with somebody the other day, these bounces we have, like you have these real rips and dips. You have a 200, 300 point rally in these in a bear market or in a downtrend. These things come into play. These counter rallies against the trend are usually really sharp, and what they're kind of designed to do is to make you doubt what you're seeing over an extended period of time. So we look at all these charts and we see this downtrend going from midsummer, trying to have a few bounces and rolling over again. Okay, these little rips where all of a sudden you get a 300 point rally. They're trying to change your whole thought process of what's taken several months to build up. So use them as a chance to get out. This thing would have to take out the highs going back several months before we're even going to look at possibly if we're putting in a bottoming pattern. Okay, next I want to talk about, generally we'll look at the different sectors, but I knew this was going to take a little bit of time this time. We had a lot of questions came in this week, so ahead of the call. So I want to jump to those questions here. We had about 9 or 10 of them. And you can also start to put questions in at the bottom here that we'll try to get to before we wrap it up. But I want to know, someone want to know if they could buy commodities in here for an oversold bounce. So the first chart we're going to look at right here is the Deutsche Bank Commodity Index. It's an ETF. I think it's trading today at about $12.44. The commodities are very oversold. So you probably will get some little bounces in here, but as you can see, going back into June, these bounces are they last maybe a day or two tops, and then we just roll back over and start heading south. So if you do get something like this where you see this MACD, it's anything below this around 1.5 is a very oversold market. Maybe you get these things and you watch crude oil or something get a little bounce, and you can play a 1 or 2 day spike. That's going to be it. What I do like about the commodity market right here is this up-down, 50-day up-down slope ratio. That is showing that there is some accumulation. So you are getting some people that they've decided they're cheap enough that we're going to try to we're going to start to nibble away at some of the commodities. But another thing you may want to look at when you're going to get the bounce, if you want to play a bounce in this ETF, is to look at some of the countries that country ETFs where the country's economy picks up by a pickup in natural resources. Just some examples of some stronger companies would be EWA, which is Australia, or EWC, which is Canada, even RSX, which is Russia. These country indexes will follow commodities. Here's this is EWC. This is Canada's stock market, and you can see how it's trading in tandem with the decline in commodities. So when you start to see the Canadian market try to find a bottom like over in here, and you saw a nice little pickup in commodities, but they both rolled over at that point. Here's the Australian ETF. Again, you can see it's trading in tandem with commodities. Not much of a pickup, but once the Australian market begins to show signs of life, that would be a sign that you can come in here and pick up some of the ETFs on a quick trade that perhaps they're putting in a bottoming thing. Okay, we had a question was to look at orbital ATK. The symbol on this stock is OA. It's got a nice looking chart. It had a point figure breakout after Goldman put it in their conviction list over here. What I wanted to say is, if the last couple of weeks we've been talking about what industries might be outperforming, and this is in an industry that is outperforming. This is in the aerospace and defense industry. We've been recommending this for a little while. It's outperforming. That industry is outperforming the S&P 500. It's got a 50-day relative strength of a 1.03. The industry is showing some signs of deterioration over lately, but you have to kind of expect that with the broader market. But overall, the stock's in a nice uptrend. It's got a clear channel over here. We want to watch to see if it's going to hold support over here at 86 or 87. Selling in the broader market could bring this down to around the 81 level. Our sell stop was in at 86.25, but your risk on this stock is the broader market, not so much the this stock. If you get a big pull off, you get down to $80. I think it represent a great buy. Goldman also likes this sector. They thought that they had some notes out here a couple of days ago talking about Lockheed Martin. The symbol's LMT. Northrop Grumman NOC is the symbol on that. These stocks have great looking charts. They're near their 52-week highs. And what Goldman was trying to say was that when you have some of these industry rollovers, something like in defense industry in particular, that we may just be seeing the beginning of a uptrend in defense stocks. Probably the world terrorism events are probably contributing to that. But they think this is an area of the market that you want to go. A lot of these stocks are paying some very good dividends. I think Lockheed Martin's paying around 3%. Grumman's paying about almost 2%. So they might be areas that you might look at on pullbacks to add to positions. But as far as OA goes, I think it's a great-looking chart. I think it probably works its way higher. Your downside risk, though, on this at this point is a broader market sell-off. Okay, we had a question about Starbucks. How does it look? Symbol on Starbucks, SBUX. Again, it's a nice longer-term holding. I think you're susceptible in here also to the broader market. It's looking for support down here around the 200-day moving average. It hasn't quite bounced off of it yet, but support is in the 50 to, let's see, support's in here around 56 to 58. Break below 56 could take you back down to in the $50, $52 range. I wouldn't be jumping into this thing. You also have a downward trend line coming into play over here. But a break below this 56 area, and you could get a chance to get in down here, maybe around the 50 if it visits the August, September lows. Again, this is probably a stock you may want to own for the longer term, but also look at the distribution of it from back in the summer when we were trading up here around 2 point something on the up-down ratio. We're down here below 1 now. So this is showing you that the stock is under distribution through this period. So I wouldn't be a buyer of it right at this stage. I might give it the broader market a little bit of room. Celgene was another one we had a question about, and they wanted to look at the biotech ETFs or sector also, or industry group. I don't. You can't like the biotech industry in here. There's more downside to this oversold group. It's had about a 25% pullback. You can see Celgene here breaking support lines that go back to last November. It broke this area here. Your next support level could come back in here around $85 or so. It just doesn't. If it breaks through this $95 range here from the August low, you've got a long ways down here into the 80s before you're going to find support. You see the relative strength kind of rolled over, and down here again, you're showing signs of distribution. You had a nice little buying over here, but now you're kind of heading lower again. Anything below 1, you kind of have to take with a grain of salt. Here's the iShares Biotech IBB. Again, it's already testing the lows from August to September. Break below, let's see, if it breaks below this 285, 286 area, it's got a long ways down. Again, you can see it go down here around to this 260 or so. So I would probably not buy the biotech shares. In fact, one of the things that I want to talk a little bit about some of these pharmaceuticals. When you have a stock that's kind of speculative like this, you're going to get a spike in some of these stocks like Celgene or some of these that maybe get FDA approval and something like that. If you get something at like $30 and it jumps up to $38, $39, you like it for the long term, but you have a sector, an industry that just keeps going lower and lower. One of the ways that I play these things is I'll give up $1 or $2 over the long term of profit and buy myself a put. That way the thing rolls over, goes back. They sell the news, and you buy the rumor, sell the news. It goes from 30 to 38, then comes back down to 20 to 29. At least I've been able to pull my profit out by buying a put. It locks that in. Otherwise, you've had to run up and you give everything back away. So don't consider that on these stocks that are coming out with these big news announcements. Another stock that someone asked about was, can you look at Thermo Fisher Scientific? The symbol on this is TMO. This chart again looks okay. You've had a nice run off of the October or September low. Made a new 52-week high up here about a week and a half, 2 weeks ago. The chart looks good. The industrial sector, as you know, I'm lukewarm on it because I'm not sure whether Thermo Fisher gets most of their revenues overseas or domestically. But if it's overseas, I think the stronger dollar, which is still firm, is going to cut into some of their revenues. So I would be a little bit hesitant to be buying it in here. Also, if you might have the works of here's a shoulder, maybe a head. This thing come up here around 140 and roll over again. You could have a break in here at this level and get a trade down below to about 123 or so. So I would give it a little bit of room. Your main risk, I think, on this again is the broader market. Another question we had over here was Illumina. Again, it's another biotech that I think looks lower. Obviously, you had some good news coming out on their cancer drug. That again, you buy a lot of accumulation in that, and now you've had in the last couple of days you've had another rollover in this thing. I guess it's sell the news. Again, you have support down here around the 150 level, but you're in the wrong sector. They say a rising tide lifts all ships. Well, when the tide goes out, everything else goes down too. So I would probably not want to look at this. I think you can see this thing probably test the August, September lows, mainly because you're in the wrong sector. Another one here, another pharmaceutical biotech. It's Enta Pharmaceuticals or Enenta, whatever. You've got a consolidation period over here after a pretty significant pullback. Supports down here around the 28. Now this would be one that you could buy a put on if you had bought it over in here. You had this run up like this where you go from like 30 to 50. Sure, you buy a put in here. You buy one for about $1.50, $2. Go out a month or two. This thing rolls over. You sell it for $10, $12. You've lost all your profit on the stock, but you were able to make the money to the downside. If it kept on going, you gave up $1, but you locked in your profit. This will keep something going like this. This had another big spike on some news, I guess, in here. And then it's pulling down. Looks like another case of sell the news. Okay. Okay, we're almost at the 12:30 here. I'm going to open this up to some new questions. Everyone, okay. Here we go. So we got two more in here. Can you show us RWN, the inverse IWM, and PSQ, the inverse QQQ? Let's see. Okay, I'm going to have to share the screen to pull these up. If you don't want to look at the inverse ETSQ, look at IWM and QQQ. Thanks. Okay, I'm going to try to share the screen at this point. So we're going to close this down. Okay, we did look at the Russell 2000, which was the IWM. So I won't look at that. Is this ready to go? Or no? I will look at that. As you know, it's already taken out the Russell 2000 has already taken out the August September low. It doesn't look good to me at this point. I would not be looking to catch a falling knife on that. Okay, here's the what do you think, GNTX? Let me see here. Okay, here's the again. We looked at the Russell 2000 over here earlier. Again, this isn't something you want to be on. I think we've been down like 8 out of 9 or 9 out of 10 days. The inverted ETF on this thing, they said, was RWM. Oops. Okay, look, it's just an inversion here. You see this thing breaking away. Again, it's overbought, extremely overbought. You got a lot of people buying into this though down here. If you look at the up-down ratio, it's picking up. They took some money off the table here, but they're going back into it again. MACD looks good. You're breaking out to a new high over here. You could probably this probably has a ways to go. It looks fine. Now, as far as when I would look for a bounce on some of these, like the Russell 2000 and stuff, keep an eye on the VIX. The VIX has been bouncing around at this 25 area, 24, 25. I even got to 27 the other day. We're at 23 right now. It's off about 3%. You got to see a spike to probably 35 on. This has been a pretty steep pullback. And the fact that this thing can't even spike to, like, say, 35 or so means that there's not enough fear among the traders quite yet to stage a good 2 or 3 or 4 day rally. When you see it jump up around that area, you might do a quick bounce on the some of these indexes. But at this point, I'd hold off. Okay, we have GNTX. Let me see. Is that what that was? Gentex Corporation. I think that was what you were asking about. Let me double check that real quick. GNTX, yeah, okay. It's the same story. You're in the wrong industry. This thing's going down. It's already trying to break below the August September lows. You're not going to make any money in this. You've already retraced this whole move from last September or September of 2014, where you had the big spike up at the end of the year. You spent the whole year going down. You're not gonna. This isn't where you want to be yet. Maybe if it comes down and holds this 11, 12 area, you might sample away. Another thing to do on these things, because I think they're long-term results as these new drugs are coming in, is going to be good. And maybe you buy if you want to own 1,000 shares, you buy 150. If it gets down, if it comes down to the August lows, you buy another 200 shares. If it comes down and tests the October 2014 level, you just don't barrel into it all at one time in an industry like this. So just hold off on some of these like that. Any more questions over here? Because we've already gone about 35 minutes. I don't want to bore you going more than 30 minutes. If I don't see any more coming in, next week I had a couple questions about the CTI, which is a cyclical trend index, which went to a bearish sell on the market in November. I'm going to go into that in more detail. What it does, it picks up business cycles and different cycles of ups and downs in the market. It's worked over about 85 years or so. It's outperformed the Dow almost 2 to 1. So it might be something that you might have an interest in. According to our CTI, we may be getting close to this thing putting in a short-term bottom, which will, if you read the market letter on Fridays, we will try to get into that again. Okay, where are we headed on oil? $20, $25 on WTI. The market might stop falling if oil stabilizes. The last couple of weeks I've been talking about what I thought might happen if you break down below this 31, 32 level. There's a chance that you could get a capitulation low that would take you down into the 20s. I still think that's possible. You're down about another 4% today. WTI is at 30.13, down another $1.29 today. If you're looking for a bounce in oil, this is an ETF called USO, which I think would be a good way for a 1 or 2 day bounce. You can see these little things in here. This goes back to 2014. If I make it for 1 year, the reason I kind of like a bounce off this, you can get a lot of leverage for your money because you're buying an $8 or $9 oil product here. But you also don't have a surprise where if you buy an oil company or oil stock that you think has some good longer term potential, all of a sudden they come in, they cut the dividend because they're running out of money. All of a sudden you bought a stock for a bounce and you're down 25%. something like this USO or an ETF like this, you're going to eliminate that risk. So that might be something to look at. But no, I don't see it. I don't know where the bottom is on this thing. Again, if you get a capitulation where you just slide down one day, or everybody throws in the towel, and you get down to $26, $27, $28 maybe, sure you could get a bounce in that. So, but this might be a way to play that. Let's see. A couple of days ago, Mark has recommended a Cornick as a strong buy, so I bought some shares. They had tanked from 38 to 33. What happened? Give me the symbol on that Cornick, and we'll take a look at it. But again, I'm not sure you want to be buying stuff. What do you think of Intel? Okay, Intel, INTC. Okay, well, you see this big drop in Intel. It's trying to hold up here around 35, ran resistance around 35 and change. Now you're down here. You're trying to hold the 200-day moving average. I think what's holding this thing up in here, I think, is that Intel is paying about a 4% dividend yield, which will bring in some buyers. But there's the up-down slope on this thing. Once we got into November and made this high in the broader market, this is one of the stocks they sold pretty rapidly. And then take a look at this. Okay, here's the Philadelphia Semiconductor Index, and you've gone from a high in here of around 692. You're down below 600 already. So you've had about 18-19% pullback in the semiconductors off the 52-week high. You're already in a bear market in the Philadelphia Semiconductor Index too. So that's a third or fourth index that we've talked about is already in a bear market. And again, you can see this nice run up here from off the August lows, but was oversold. But boom, the Philadelphia Semiconductor ETF, they're dumping that again pretty rapidly. They've been doing it since it made a new high over here. So I don't, Intel probably has a little bit more downside, and again, that's probably broader market risk. AKRX. Okay. Acorn, okay. Has had some news. I mean, this is a nice looking pattern. Whatever happened yesterday apparently caught everybody off guard. And this is something that technical analysis is not going to do. You look at this and you see all this buying going into Acorn. It's under accumulation, and then it fell out of bed over here. This would have been a good one for me to look at a little different time. AKR. I'm not sure what sector they're in. Let me check with that. Oops, wrong one. Okay. And we're running out of probe. Okay, this is in the healthcare, medical supplies. The healthcare is one of the better looking sectors right in here. It's had some problems, but apparently this Acorn came out of left field with some news, and and obviously it took it down here from about 38 down to about 33. Things like that, no one's going to pick that up. If this was going to be known to investors, you'd have started seeing this thing start to head down, this up-down ratio at a time. So that's one way you can look at this thing. When this thing's going down, the stock's going up, when it's showing negative divergence, that means that sometimes these things are, the street knows that something's coming up before it happens. But in this case, there was good news, and it was blindsided. So, at this point, we'll see what happens in the next day or so. Okay, explain a sell stop. What we're going to do, Levon, we're going to wrap this up because we've gone almost 40 minutes, which is a little longer than we'd like to go before everybody starts getting bored and falling asleep. So, again, if you can send your questions like you did last week into the doc at marketedge.com. It gives me a couple of days to look at something, and we can talk about it. I can give you a little bit better picture. At this point, we'll look again. We're still bearish on the market. Try to read the market letter on Friday to see if anything picks up between now and then. Otherwise, we'll see you next week. And, again, send your questions into the doc at marketedge.com, and have a good week.